going to focus on curation. Curation is emerging as one of DeFi's fastest growing layers, reshaping how protocols, treasuries, and allocators discover, rank, and deploy capital. So as the ecosystem evolves beyond liquidity mining and yield aggregation, curated markets are becoming central to risk management. So in this panel, we're going to talk about how it's scaling across DeFi, some of the risks that come with that, how those risks can be mitigated, as well as some of the opportunities for structured on-chain strategies and how those could potentially scale to the billions of dollars or even beyond. So to start off, the first question is going to focus on trust. It's a pretty central issue to curators because one of the things that I think brought a lot of us to DeFi is the fact that it removes a lot of trust that you normally need when entering financial products. But curation implies judgment. There's someone curating the product. So how can judgment be more transparent, and how should users evaluate who is worth trusting as a curator in DeFi? And we can start with anyone.
Yeah, I can start. Yeah, first of all, hi everyone. We have to realize that it's still a nascent space, right? It's been not even 2 years since Morpho really started the concept around curation. And so far, it seems like all of the trust has been assigned to the actors that were there before managing risk on other platforms. So mostly treasury managers or people that has been helping out the development of other protocol platforms back in the day. And that's one of the trust factors. And the other one is really about making sure that the strategies are deployed in low-risk markets or at least ones with the biggest liquidity and backed by hard assets, such as BTC or ETH or LSTs. This doesn't necessarily mean that it's lower risk, right? I don't think that returns are a great proxy for implied risk. Past performance are not guarantee of future returns. But it just seems that so far, the lack of tools to be able to standardize how people are managing risk, it's been, people are just relying on actors that haven't lost funds for their investors, and that's how it's been so far.
What tools would you like to see created?
I have mixed feelings on that end, because the worst thing that it could happen was to be, for DeFi to end up where TradFi is right now, which is, a bunch of regulators on top of it. I know they feel stuck, and yet, we see all the time, some capital losses around some of the structured products that we see out there. So it's not necessarily because of the fact that you increase regulation that you're going to have better risk-adjusted returns. But maybe something around making sure that all of the pools or all of the vaults and all of the allocations are done in investments that maintain all of their backed assets on chain or that have all of their information or the implied information to be able to price the risk on chain, which hasn't been the case so far. And we've seen a couple of weeks ago, a couple actors blowing up just because they took risk on stuff that has loads of information off chain, and it's just a factor of I guess people chasing yields. But as I can only speak for KPK, the way we underwrite a strategy is always about seeing all of the information necessary for us to make up a decision on chain, and that's been up.
Thank you. Does anyone else want to?
I can add. So at my point, and just to explain the place of curation, because right now there are a lot of debates, should protocol manage risk by themselves? It's similar like our model here, when the protocol itself has a DAO governance process, and token holders could vote for different listings, risk parameters, etc. Or it should be done in permissionless way, like in a Gearbox and Morpho model. And I thought about that, and my point here is that me personally came to Ethereum to build a programmable finance. We want to have more data-driven approaches. And in software development, there is a very simple principle, divide and conquer. If you consider today financial institution like a bank, there are a lot of business processes. Previously, we have to trust for payments, and there are a lot of pain here, but right now, blockchain, Ethereum really makes this place very good. But we still have not enough data for software development on chain. We literally, on the smart contract side, knows nothing about what this asset is. We know the address of ERC token, but we have no information who is behind this token. And bringing this data and helping Ethereum to make these things functional, we should have a kind of part of stack which is right now done by risk curators, because we want to really decompose the big task into chunks, solve payments, lending, then curation, and I hope maybe when we can standardize this stuff, we can really end up with much better business processes of risk evaluation. Then we even have a TradeFi, maybe artificial intelligence, maybe we can have a pretty complex math, like quants do, to make things clear. But I definitely believe in Ethereum especially, we have a kind of great vibe of transparency. And it's a key thing what we should do, because if you really open all financial data for researchers, for smart people, for academia, they could really learn from this data. They could understand basic things upon the numbers and maybe suggest something. If you want to go to the wrong path, when people say, hey, we want to create some kind of risk score, we will analyze how people behave, etc., it's a little bit different way. You should trust people to people, and we could not extract the data we need for decision making. So I think it's risk curation, it's kind of stage of market. Maybe we can find something better. Maybe we can decompose this risk curation into a few parts, but I still believe programmable finance is the future, and somehow we really cut the big financial system by chunks, automate, digitalize every process, and we can build trust at the end. So give software developers power, give experts and researchers data, and we will build something better.
Yeah, so much agree with this. This approach or this way of thinking about the entire system, because if you want to judge the trust level with curators, sure, you can bring the rating agency, auditors, regulators, and that's kind of fair, because I see that institutions or governments disappear gradually, and they disappear through this modularization. This module we can decentralize, commoditize on chain. This module we can remove the fees entirely, so it becomes a non-issue. And the organizations are smaller and smaller and smaller, and the smaller they are, the theoretically more efficient they should be. So we remove this transactional costs from the outside and allow the things to be entirely competitive on chain. And if we bring something on chain, then we have that programmability, we have transparency, verification, where it's needed, we have privacy, and then it's great. And for the curation, I think it's totally okay to provide trust as a service on top of a trustless system. So blockchain should remove trust from some most basic components of the processes, like you suggested, the payments, transactions, the ledger itself, the data. But it's okay to trade everything on top, and that everything can be also additional trust services that were not removed so far, and you can offer them and say, I want to be paid for that.
Yeah,
Next 10 years of Ethereum, yeah?
Yeah, hopefully faster, but especially with maybe AI curation, that probably will take a few years, and that might be very much supported on this side.
Yeah, I'd agree with that. If you actually look at what's happening today, there's almost multiple layers of curation. If you think about it, many of these vaults that are being created are actually being abstracted underneath other interfaces for retail. Like you have the base app, it has the Morpho Vault, you have even in MetaMask, there's MetaMask Earn. So the user already is actually trusting a layer that's one step above already the curator. And so how do you get these like rating agencies there to kind of inform end users who are actually like depositing funds, not necessarily knowing the underlying risks, the collateral, the potential bad debt. And it's also happening on the sort of institutional side as well. Like Linea's recently partnered with Sharpling Gaming. Sharpling's bringing its ETH digital asset treasury to Linea. Obviously, they're asking us, how do we then look about deploying that across DeFi on Linea? So they're kind of seeing us now as a curator because they don't want to necessarily go in and directly interact with these vaults. So I think there's kind of this layer of like trust still above, and it's probably a bit of an anti-pattern. We need to be able to create the systems directly on chain with ratings and reputation and ways that then people can actually, again, not get re-intermediated, I would say, and give users and fund managers the right level of actual like risk-adjusted understanding of the performance.
Thank you, everyone. Next question is about risk. So I think this has been especially pertinent recently, but is curation reducing risk or simply redistributing or maybe obscuring it? When vaults and structured products wrap other protocols, how can users and creators and other ecosystem players be sure that they're not creating layered leveraged risks that could blow up?
Who wants to go first?
I can just tell some numbers to understand regarding risk curation. And I think we are at the beginning. And the biggest risk here is not related to curators themselves. The problem more in people's mind because curation premiums are quite low in comparison with the risk they should take to make a kind of decision. So literally people, and I more prefer when people could learn basics about finance, learn more about self-custody, etc. But people, of course, like to prefer and trust some brands. It's like kind of our nature. We could not be experts in everything. On the other place, if curation would be done in traditional finance like a banks, which could give you a guarantee of returning money because your deposits are protected by the law and there are a lot of constructions on top of them to really mitigate potential risk. Curation could earn, 10 times more money to create such kind of safety buffer to cover this risk. So I think we are at the beginning of this way. I really appreciate Karpathy and big players who can at least bring their experience, bring their understanding of finance. And then, of course, I think our role is just to explain for end users that not all risk curators are equal because as usual, there are good curators and bad curators, and I think people who comes to industry with long-term vision would win at the end, and I think they could make a sustainable business because people, after a few experience what happened with XUSD collapse, start thinking and they will really choose by brand experience, not just to chase a high yields.
Yeah, I think we're in this weird situation. I do believe that it's just a vector of how, the immaturity of the industry, where in order for you to become relevant in the curation space, you have to attract TVL, and in order for you to attract TVL, because all of the market is still skewed towards the retail, and those are definitely more prone to risk because they just hold on to the strategy that gives them the biggest APY. Really creates this perverse cycle where you go down, or maybe involuntarily, curators go down the risk curve just to be able to attract that attention and that TVL, and to eventually to a point where they end up blowing up. And I do think that we fix that cycle by opening up the floodgates to institutional capital, and those entities that manage capital like Scale, that are confident with what we call low risk DeFi, right? Not necessarily 10% APY, but just a couple bips on top of the risk-free rate just to make up for the additional smart contract risk or whatever. And eventually we're going to find or converge onto the actors that are really there for the scale and the long-term vision, as opposed to the guys that just chasing short-term returns. To the point on whether we're just bypassing risk, I do think that's a necessary. That is a necessary condition given the complexities of of DeFi and what it entails to be able to manage capital on chain. I do think that's the way for us to scale. Actually, I don't think that by centralizing decision making around whitelisting specific markets, using DAOs or whatever governance structures you want to use, is the way to scale. I do think that we ought to create a platform where reputed actors compete for the best risk-adjusted yield, and then let the market figure out where to move next. But definitely, we have to go past this, perverse cycles where, because the market is so small, people just chase down the risk curve and then end up blowing up.
So maybe here you look at it more practical way, and theoretically, I see it maybe as immature market if we don't talk about the risk targets of the vaults themselves. So it's totally okay to take a lot of risk and introduce the risk as long as it goes on the efficient frontier side and it gets proper risk-return ratio. Now, it definitely feels like a mature market if you have overwhelmingly curators that would take the vault and not think about what's the risk level that vault should have, and start taking more risk than is the target, and not thinking only about within this risk levels, how can I optimize the return. And then maybe from the perspective of those who are allocating, it's the question of the fully programmed vault that wouldn't be curated as potentially very risky. You're bringing people because you want to decrease the risk and trade it for the trust, which potentially is a risk. You're replacing counterparty risk with the risk of this systemic or programmatic blow up, and I assume that people just calculate that it's better trade-off, right? That you bring less risk than you remove, and any very high quality curator will be able to remove the risk. And over time, we should just have that trust being properly priced and have great results, and this will be a mature market. And I don't think for the next few years we'll be able to fully automate those processes.
What disclosures do you think are the responsibility of curators as far as risk?
That's a very good point. I'd like to believe that the transparency nature of the blockchain really allows us not to have to disclose anything, because we believe that the market itself is going to be able to price the risk that the curators are incurring into. Our job as curators is also to be proactive in educating the market and letting them know the way or the framework that we're using to measure risk, and all of the tools that we're using to reduce it to some extent. But I do think that it's still nascent. And to your previous point around how do you actually measure value at risk when you actually don't have the full spectrum of the information necessary to be able to come up with those numbers. And those RWA vaults are just one of those examples where you're lacking a lot of significant information to actually price the risk that you incur into. It's kind of on the one hand, we really want to go past the 2021 175 billion mark, but on the other, and everybody thinks that RWA is the next thing, but there's still a lot of I think infrastructure to be able to plug it in ways that allow a seamless integration and seamless onboarding into DeFi. That's how we feel.
Yeah, testing. Yeah, I still think it's difficult for LPs to actually fully underwrite the risk from an insurance perspective. Like if you take traditional finance, usually, let's say if in the equivalent of bad debt in crypto, right? In traditional finance, there's legal reconciliation, there's serious consequences, and today we just sort of get liquidated. And so usually you can underwrite that with some insurance, and we don't really have a good way to do that yet on chain. So you see these incidents even, a few weeks ago, unfortunately, where Balancer had an incident, after many audits and years of being battle tested, people lost a lot of money, and that really sets the space back. And then you go to talk to these next wave institutional capital allocators, they see that and they have no way then to actually really understand and quantify the risk. So it's kind of, you can say here's your sort of rough risk-adjusted yield, but I think until we add those mechanisms as well in terms of providing some level of insurance and guarantees, we're still going to have a huge gap between actually bringing those kind of serious capital allocators for low risk DeFi on chain, because for them, it's not really low risk DeFi. Like it's, you know, again, there's very few protocols that these serious large actors are actually willing to put their, you know, large amounts of capital. We're talking like 10 figures and more, like into these protocols. So I think that's a kind of key step, like on the security and insurance side, that as a whole industry, I think we need to work towards.
I feel the same, that the moment where we have insurance, when we have proper risk hedging, when we have all the data about the risk that they're missing, for many years we've had this situation where we're still dealing with the basic problems of like key management, security, and then regulators were blocking much of the very well experienced experienced people to come and help with the aspects that are so well understood around risk insurance. And when we now have the green light for people that are experts to come and bring all of this together, I think we'll have much better world. As for disclosures, you mentioned disclosures. Once again, theoretically, there are so well-established standards about the behaviors, the performance reporting standards, the ethical conduct standards. We have those like a big component of this CFA training, and all of this can come to blockchain. We can deploy some of it in an automated way. Some of it will be just maturation, and maturity of the industry is probably just the quality of people that will come and will be able to see the numbers that are high enough to justify that they bring the expertise to blockchain. And for a long time, we had numbers that were more risky, and the returns were huge, but the risk was also enormous. So lots of people didn't want to deal with that risk. Those who are a bit more experienced with operating in the lower risk areas.
I think it's also pretty significant to distinguish smart contract risk and risk related to assets. And I'm a little bit worrying to see what's going right now, especially with the case of stream finance collapse, because previously it was a way how we try to build decentralized finance, and it was a meta of 2020, 2022, when everything should be on-chain, etc. Unfortunately, there are a lot of protocols who try to move money back into custody and manage different tradings on CEXs, which ended up with some problem. Yes, stream finance is not an on-chain problem, and I think the lack of transparency, which is a really crucial part of DeFi and Ethereum and blockchain itself, could really help to understand things better, because I know potentially, of course, never could give you an insurance regarding potential hack, and Balancer is a very bad example. It was 5 years in production. People trusted a lot. Of course, we can build better protocols through removing a honeypot. For example, in Gearbox, all money distributed across credit accounts, which really reduce the surface of attack. So you can't hack multiple credit accounts. You can really attack the pool, but if there is not a big honeypot, hackers are not interested in. But the next part, I think we should still try to focus on transparency. And each time, especially for stream finance, we were happy to avoid this 30 million bad debt, because when I learned from our analysts the problem and asked what about their reserves, and it was said, hey, we have a meta alpha in a CEX, so we can't explain and show the data, it's a private, etc. I think it's more about values. When we can talk more about transparency, we can tell more about open financial system, we can really build terms when people who want to really bait some shady stuff would not be able to get capital. If we can assume that it's fine to move money into custody and then play casino on its CEX, it could end up with some losses. But I think people should learn this lesson, maybe with less losses. So it's also on us just to teach users and explain how it could end up with these non-transparent strategies.
Thank you. If curated vaults and approved lists become the dominant way that users interact with DeFi, how do we ensure that that doesn't turn into gatekeeping and that permissionless innovation is still possible? for example, a new innovative source of yield where maybe the risks aren't known? How do we ensure that that's not completely shut out of the ecosystem?
Do you want to go first?
I can talk only some practical stuff because we right now we switched to permissionless in the Gearbox, and we last year built a lot of tools how we can help curators to analyze everything, including, for example, liquidity levels on different sexes. Because all time when you do some risk curation, you should understand the consequence of your action. So we built a lot of different simulations. We check all possible liquidity in particular specific chain. We work with multiple L tools and of course mainnet. Then you can make some stuff. We also built a lot of monitoring just to highlight there is a lack of liquidity, etc., just to make this decision smoothly. So I think tool set for risk curators should be based, of course, on on-chain data, but I believe there are a lot of smart evaluation things from classical quant and math theory when people could analyze and predict the next step with any stuff. But I believe this is a very hot topic, how we can really serve curators better to really bring all data on-chain. It's not enough, it's not transparency, it's overcomplicated to get data. We have Block Scout and Etherscan to get raw data, but and Dune when you can build an SQL query, but it's still quite complex to understand, for example, liquidity levels in dynamic to find some stuff. So more querying data from on-chain sources could really benefit with better risk curation tools. And Karpathy also is a very good our users. We really learned a lot interacting with you, and we try to really serve these needs to get a full picture before any asset would be listed.
And how do you, and I totally appreciate that. It's actually weird because I just checked a thread a couple of weeks ago on X, and people were asking, oh, if this is a deflationary technology, and at the end of the day, yields are going to compress, and the fees that you have to pay for third parties to manage your capital are going to zero. How do you subsidize all of that technology, right? And how do you balance that, right? Because it seems like it's not taking us into a great place. It seems like all of the actors that are already there and do have sort of the capacity to be able to underwrite risk and to put up all of the execution infrastructure to limit risk as much as possible are the ones that they have yield sources anywhere else. So examples of KPK for DAO treasury management, examples of Gauntlet exactly the same. Stakehouse has been a long-term service provider for a bunch of DAOs, and then they have really interesting revenue sources from that business still. But it's interesting to see, and I honestly don't know where this will take us in the future, right? Because if revenue is compressing on the curation side, and yet people are demanding for more sophistication on the infrastructure to be able to take care of their money, where is this going, right?
I think it's because we are so long in crypto, and today it's more related, a lot of discussion about revenues here, but let's compare with AI. Yeah, AI works and really accrue profits just to really take a lot of mind share of end users. I think the same way how we could steal and build the better way of DeFi to attract real users. And I believe risk is the biggest barrier for people to trust the system, because all time when any negative things happen, it's a lot of FUD of Twitter, and we can see it's a really capital going out, people are really scared, and the fear greedy ratings go to fear almost there. So I think if we could continue together build these tools, and we also try as a paranoid protocol on security, try to understand what's going on, because as for me, it's pretty hard to make any decision if I have no data. Here it's kind of more, maybe you can go to church and ask a God what is the best collateral, but if you want to do it through the mass way and data-driven, you should collect this data. And of course, we built a lot of stuff for the last 5 years, so we're happy to analyze and bring it into curators, and together you can use your off-chain metrics, how to compute this data, and all together we can bring a product which is safe and understandable for end users.
Yeah, I think it's totally fine to maybe increase the amount of trust that we need, but in absolute terms, but decrease it in relative terms. So it's all about the volumes and how much of the assets will bring to chain. So if we hope that it goes 1000x from here, the like RWAs, the stable coins, the assets that you're dealing with, then there will be space for revenue. But it should never be the levels of revenue that you can generate from the risk management in the traditional systems, because in the end, that's what we're building, the systems that require less risk, less trust, so that can become cheaper and there'll be less intermediation. I think there is space, a lot of space for that, but it shouldn't be the levels of money making from the traditional finance.
It could also be a factor of, most of the capital that is flowing nowadays towards those curation platforms is already smart capital, right? It comes from people that already understand the system, and it feels like, the smaller the delta in terms of knowledge within the system that you're operating in, the less is the capacity of you to capture revenue. So my hope, right, and KPK's hope, is that in the future, when we onboard all of this institutional capital that knows and understands very little about DeFi, we're going to be able to increase revenues just because of the lack of understanding and them wanting to participate but not wanting to take the risk on their own, and much rather trust on entities that have been out there for the very beginning. That's how I like to think about it.
But maybe just to kind of circle back on the gatekeeping question, I think when it comes to concern about perhaps creators becoming gatekeepers, it's really just you can have gatekeeping at any layer of the entire stack. Right, so it's all built at the low level on the network. We're building permissionless systems. There's no gatekeeping there, or there shouldn't be. You then have the asset issuers and the protocols themselves, and as long as they're providing the right amount of accessibility to whether it's retail or whether it's institutions, and maybe that comes with some form of ZK KYC for needing to do accredited investors. I think as long as the assets and the protocols are not gatekeeping, then you'll always be able to have a permissionless curation system. Because if one person says, I'm going to only be able to provide access to this asset or this strategy, this financial instrument, then another one will be able to come along and sort of, provide the same offering. So I think that sort of permissionless nature at the curation level is still not something we need to worry about too much.
And also just to end up the idea, I think it makes a lot of sense.
Oh,
what's up? Hello.
Yeah.
So just to finalize that idea,
It turned off.
no? Yeah, no? Yeah.
It's
I'll
off and on.
Okay.
Occasionally.
It kind of feels like I have to. Kind of feels like if it's not transparent the way curators are earning revenue, it probably means that they're finding perverse ways to undercut you and using their gatekeeping power to be able to monetize in weird ways, right? And we know that there's backroom conversations and money flowing around that you can see around protocols pushing for curators to deploy on their newly issued markets on Morpho, right? So I think the clearer and the simpler the revenue structure in the long term for the curators, like the best, or at least the less risky or the less trust assumptions you can make, as you know for a fact that where the revenue is coming from.
Thank you. So we are almost out of time. We have about 2 minutes left. So we'll do one quick question that maybe people can give short answers to. If curation is to scale to, say, hundreds of billions of dollars of assets under management, what's the weak link that needs to be fixed first?
Guys, you want to go first?
I think in curation we should tell more users, and maybe we should diversify the products. In many cases, and I am not happy with this, people call, so it was like my personal things last 2 weeks, because especially like in the Morpho and initial landings were positioned as a kind of digital Web3 banks. And then when this XUSD was collapsed and some protocol accrued a lot of bad debt, the people start talking that now they are vaults, not lendings. And at my point, this misconception brings a lot of bad things in people's mind, because people want to consider lending similar to banks, and vaults is something under the risk, and we should clearly distinguish these products. If it's technically the same, if the smart contracts will be totally the same, we should explain end users about potential risks and create this low risk DeFi, as Vitalik said, for people who are really looking for something for their lifetime savings, and not call this vaults. And vaults could be for some risk, and both of these vaults could be managed by curators. But we should really have a very clear statement for end customers, not to make them fear and misunderstood what's going on, why I go to a lending market, it repositioning like a bank, and then boom, as a result, someone picks the money and play casino. Because I never believe that asking end users to make a due diligence before depositing money on LP side is a good idea. It's how people have not enough days. So I think this clear positioning and low risk DeFi, it's a good way to improve the industry.
Yeah, maybe I'll jump in. So I think like curators are just fund managers. We know very well what this world looks like in traditional finance. And I think, again, the thing that's really missing to get to, what do you say, $100 billion in assets under management, it's still just ways to properly underwrite these vaults. Like, and for me, that's definitely insurance. Like, I speak to a lot of these more like traditional institutional capital allocators. Every single one asks me, you know, can you provide insurance for this? Like, how does this work? And today the current answer is like, there's not a sufficient answer yet that's adding friction to actually getting to that $100 billion number, which is, again, is quite small compared to where we really should be going, which is even further. Yeah.
So the Ethereum Foundation, what we do is that $1 trillion security program, which is to generally think of how to further improve the Ethereum security to make sure that people start feeling very comfortable with allocating trillions of dollars to the ecosystem, and that will create much more space for curators, for automated solutions, and for everyone in the DeFi ecosystem. So more and more security and consideration of the really large-scale attacks, threats, Web2 infrastructure threats, that's what we'll focus on.
Yeah, just to add an additional thought, more infrastructure to bring off-chain data on-chain, right? And we definitely need to bridge that to some extent. I think we're just scratching the surface when it comes to that. I mean, so far we've been super good at, as a DeFi investments, to express people's demand to leverage some native asset, but that's just the tip of the iceberg in terms of the financial products that can be built on-chain. You know, the DeFi fan in me really wants to see real-world use cases being expressed on-chain. So,
Absolutely.
you know, payments, authorizations happening in smart contracts instead of in centralized credit card rails. You know, lending, potentially finding ways to have under-collateralized lending happening on-chain as well. Stuff that really happened in normal lives that can be much efficiently built on-chain. That's what I signed up for a couple of years ago, and the stuff that keeps me awake every day. And on top of that, obviously, I don't see the industry expanding if not through direct integration of DeFi into the distribution channels that people have already today, right? I do like to think of DeFi as the wholesale, you know, financial market where everything happens, and if you want to plug directly, if you have the knowledge to do so, you can do so. But the way we reach 100 billion, the 100 billion or even more in capital, or 1 billion users is by using, you know, banks and traditional sort of neobanks or whatever, because they already have the distribution in place. It's just a matter of, you know, replugging all of the infrastructure that they're using right now and distributing directly to the end consumer. That's, you know, I know it's not sexy, but I don't see any other way of us, you know, scaling DeFi to the levels we all want to see.
That concludes the panel. Thank you to all of our panelists today.
Thank you.
Cheers.